Yesterday was the most important day in the silver market in 2026. It was first notice day for March COMEX silver futures, and the numbers just came in. 10,526 contracts are standing for physical delivery. That's 52.63 million ounces of silver that buyers are demanding. Not paper, not promises, physical metal. Deliver it to my vault or we have a problem. And here's the number that should terrify everyone watching. COMEX registered silver inventory, the silver that is actually available for delivery, sits at 86.13 million ounces. That means 61% of the entire registered vault is being demanded in a single month. But it gets worse, because this isn't happening in isolation. January delivered 49.4 million ounces. February delivered 25.18 million ounces, the highest February delivery in modern COMEX history, 5 to 8 times the historical average for a minor month. And now March is demanding 52.63 million. Add it up. January plus February plus March. Standing delivery equals 127 million ounces. The vault has 86 million. They have already delivered more than what currently exists in the registered inventory in just 60 days. According to the analysis published yesterday on Substack by researcher Jin Lo, COMEX has delivered 86.4% of its current registered inventory in just 60 days. Let me say that again. 86% of the vault, gone in 2 months. And here's the detail that almost nobody's talking about. When registered silver declined this month, the metal did not flow into the eligible category. According to Seeking Alpha's latest analysis, published February 26th, the metal left the vault entirely. It didn't move to a different classification. It didn't get reclassified. It physically left the building. This is not a paper shuffle. This is a physical drain. Silver closed yesterday at $90.10 on first notice day. Today, as I'm recording this, it's at $94.50, a $4.40 jump. The market knows what these numbers mean, even if the mainstream media hasn't caught up yet. I'm going to walk you through exactly what happened in February, what the March numbers tell us, why the metal is leaving the vault and where it's going, and what happens next if this pace continues through March. Because the math doesn't lie, and the math says COMEX is running out of time. To understand why March is so dangerous, you need to understand what just happened in February. Because February was supposed to be a quiet month. In COMEX terminology, February is a minor delivery month. Major months are March, May, July, September, and December. Minor months typically see 3 to 5 million ounces delivered. It's a maintenance month. Nothing exciting happens. Except in February 2026, everything exciting happened. 5,036 contracts were delivered. That represents 25.18 million ounces, 5 to 8 times the historical norm for February. And the delivery pattern was telling. On the very first day, January 29th, first notice day for February, 1,881 contracts were delivered. That's 37% of the entire month's delivery on day 1. By day 3, 55% was done. What does that tell you? It tells you buyers aren't waiting. They're not negotiating. They're not rolling to the next month. They're saying, give me my silver now. And the composition of those buyers changed dramatically. According to the commitment of traders data from the CFTC, managed money, hedge funds and commodity trading advisors, collapsed 77.7% year over year. In February 2025, managed money held 54,415 contracts. In February 2026, they held 12,121. The speculators got wiped out in the crash from $121 to $70. They're gone. What's left is industrial users and institutional investors who actually want the metal. These aren't day traders. These are Samsung securing supply for solar panels. These are sovereign wealth funds building physical reserves. These are companies that read the data and concluded that exchange inventory is unreliable. And the registered inventory tells the story. COMEX registered silver went from 240 million ounces in April 2020 to 86 million ounces today. That's a 64% decline in less than 6 years, and the decline is accelerating. From October 2025 to February 2026, just 4 months, registered silver dropped from approximately 167 million to 86 million ounces. That's a 48% drop in 4 months. But here's the critical data point from the Seeking Alpha analysis. When registered silver declined in February, the metal didn't transfer to the eligible category. In a normal month, metal that leaves registered status either gets reclassified as eligible, meaning it stays in the vault but is not available for immediate delivery, or it gets physically removed. In February, it got physically removed. It left the building. This means someone took delivery and pulled the metal out of the COMEX system entirely. They didn't leave it in the vault for potential future delivery. They took it home, or shipped it to Asia, or locked it in a private vault. Either way, it's gone from the COMEX ecosystem. And it's not coming back. The registered to eligible ratio has been one of the most important indicators in this market for the past 3 years. When metal moves from registered to eligible, it means someone doesn't want to make it available for delivery, but they're keeping it in the system. When metal leaves the vault entirely, it means they don't trust the system at all. They want their silver as far away from COMEX as possible. That's what happened in February. And now March is here. Let's do the math that nobody in the financial media wants to do. March is a major delivery month. It's historically the most active silver delivery month of the year, and the numbers are unprecedented. As of first notice day, 10,526 contracts are standing for delivery. That's 52.63 million ounces against 86.13 million ounces of registered inventory. 61% of the vault demanded in 1 month, but those 10,500 contracts are just the initial standing. During the delivery month, additional contracts can and do come in through what's called net new delivery notices. In January, net new contracts were a significant driver of total delivery volume in the first half of the month. In December 2025, the major month before this one, 46.6 million ounces were delivered, representing 50% of the estimated free float registered inventory at the time. If March follows December's pattern of 50% delivery to inventory, that's 43 million ounces. If March follows January's accelerated pattern, we could see 60 to 70 million ounces demanded against 86 million available. But here's where it gets truly alarming. That 86 million is the official registered number. The real question, the question that keeps COMEX regulators up at night, is how much of that 86 million is actually available and unencumbered. Multiple analysts have raised concerns about double-pledged inventory, the same metal being counted against multiple obligations. A registered warehouse receipt can theoretically change hands multiple times without the silver physically moving. This means the same 5,000 ounces can satisfy multiple delivery notices on paper, but only one of those parties can actually take the metal home. The Shanghai market provides the clearest evidence that the physical metal is not where the paper says it should be. Shanghai Gold Exchange, silver inventory dropped from 559 tons in November 2025 to 318 tons in February 2026, a 43% decline in 3 months. Shanghai physical silver is pricing at a 20% premium to COMEX, $102 versus $85 at the time of the halt earlier this week. London lease rates, the cost of borrowing physical silver, hit 39% intraday this week. Normal is 1 to 3%. When it costs you 39% annually to borrow silver, it means nobody wants to lend their metal. They're afraid they won't get it back. And the global supply deficit continues to widen. The silver market has been in deficit for 5 consecutive years. Cumulative shortfall from 2021 through 2025, approximately 820 million ounces. Nearly an entire year of global mine production that was consumed and never replaced. The COMEX vault isn't being drained by speculation. It's being drained by genuine demand that exceeds global production. Every solar panel, every electric vehicle, every smartphone, every data center, they all need silver. And the mines can't produce it fast enough. So when I tell you that March is demanding 52 million ounces from a vault that holds 86 million, you need to understand that this isn't just 1 month's problem. This is the culmination of 5 years of deficits, catching up with a system that was never designed to handle real physical demand. So if the math doesn't work, how does COMEX survive March? Because, let's be honest, the exchange has survived every crisis so far. They survived January's 49 million ounce delivery. They survived the February record. They'll probably survive March. But the how matters enormously for the price of silver. There are 5 tools in the CME's emergency kit, and they've already used 3 of them this year. Tool 1, margin hikes. On December 31st, the CME raised margin requirements to $25,000 per contract. This forces smaller traders to liquidate their positions before delivery. It's effective at reducing the number of contracts standing for delivery, but it only works on leveraged speculators. Industrial users with physical need and institutional investors with deep pockets don't care about margin. They pay it and stand for delivery anyway. As we saw from the managed money data, the speculators are already gone. This tool is largely spent. Tool 2, trading halts. On February 25th, the CME halted all metals trading. During the halt, 31,828 silver contracts traded, 159 million ounces, despite the market being officially frozen. I covered this in detail in my previous video. Silver was approaching $91 when they pulled the plug. When trading resumed, it was at $85. March open interest was cut in half in a single session. Tool 3, EFP deals, exchange for physical. This is where a futures contract is swapped for actual metal outside the exchange. The transaction happens off exchange, in London or elsewhere, at a negotiated price. This allows COMEX to satisfy delivery obligations without actually depleting its registered inventory. The metal comes from London, or from ETF holdings, or from private vaults. EFP volumes have been elevated all year. Tool 4, SLV raids. JP Morgan is both the custodian of the iShares Silver Trust, SLV, the world's largest silver ETF, and one of the biggest traders on COMEX. As I documented in my video last week, this dual role creates a mechanism where authorized participants can redeem SLV shares, extract physical silver from the SLV vault, and deliver it to COMEX to satisfy futures delivery obligations. SLV currently holds approximately 450 million ounces. It's the single largest accessible pool of physical silver on the planet. When COMEX runs low, SLV is the emergency relief valve. Tool 5, cash settlement. This is the nuclear option. COMEX contracts include a clause that allows the exchange to settle delivery obligations in cash rather than physical metal during force majeure conditions. A prominent analyst writing for Investing, Com stated that he fully expects COMEX to cash settle March futures contracts for those standing for delivery. This would mean buyers who demanded physical silver get a check instead. The silver stays in the vault or wherever it actually is. Cash settlement would technically be legal. The fine print allows it, but it would be devastating for COMEX's credibility. If the exchange that sets the global price of silver admits it can't actually deliver the silver, what is the price based on? At that point, COMEX becomes a casino that can't pay out its jackpots. Here's what I expect for March. The CME will use a combination of all 5 tools. More margin hikes if silver approaches 100. More EFP deals to bring metal in from London and SLV. Possible trading halts if price action threatens to trigger a short squeeze. And if all else fails, selective cash settlement for the largest delivery demands. The question isn't whether COMEX survives March. The question is how much credibility it loses in the process. And every point of credibility lost is a point gained by the Shanghai Gold Exchange, which requires physical delivery and doesn't play these games. Let me connect the dots between everything I just told you and the actual price of silver. Silver opened 2026 at around $71. In January, it raced to $121.62, a new all-time high. Then the crash took it to roughly $70. And now, on the last day of February, it's at $94.50. In 2 months, silver has gone from 71 to 121 to 70 to 94. That's more price action in 60 days than most assets see in a decade. And the March delivery data explains why the recovery from 70 to 94 is real and not a dead cat bounce. Dead cat bounces happen on speculation and hope. This recovery is happening while speculative positioning is at multi-year lows. Managed money is down 78% year over year. The hedge funds are gone. What is driving silver from 70 to 94 is genuine physical demand from industrial users and institutional investors who are looking at the same vault data I just showed you and concluding the metal is running out. When metal leaves the vault entirely, as it did in February, it creates a self-reinforcing cycle. Less metal in the vault means the next delivery month is more strained. More strain means more buyers rush to secure metal before it's gone. More rushing means faster depletion. This is the textbook definition of a physical squeeze. And the price signals from outside COMEX confirm it. Shanghai at $102, 20% above COMEX. London lease rates at 39%. Indian silver premiums at $5 to $8 per ounce above spot. Vietnamese silver premiums expanding. Physical markets around the world are screaming that the real price of silver is higher than what COMEX says. So where does silver go in March? If COMEX manages the delivery process smoothly, using EFP deals, SLV raids, and creative logistics, silver likely consolidates between $85 and $100. The delivery stress doesn't become a crisis, but the underlying supply deficit doesn't improve either. This is the base case. If delivery becomes visibly stressed, meaning public reports of delayed delivery notices, expanding cash versus physical settlement, or major buyers publicly complaining, silver likely retests the 100 to 110 range. Stress makes headlines. Headlines bring in new buyers. New buyers create more stress. Feedback loop. And if a genuine delivery failure occurs, even a partial one, all bets are off. A COMEX cash settlement event would fundamentally break the pricing mechanism. The market would need to discover the real price of physical silver through direct negotiation between buyers and sellers, bypassing the exchange entirely. At that point, you're looking at Shanghai becoming the price benchmark, and Shanghai says the price is north of 100. Here's what I want you to understand. The data I've shown you today isn't my opinion. Every number I cited comes from CME Group's own delivery reports, CFTC commitment of traders data, Seeking Alpha's analysis, and the Shanghai Gold Exchange. These are public documents. You can verify every single number. 127 million ounces demanded in 60 days against 86 million registered. Metal physically leaving the vault. The highest minor month delivery in history, managed money collapsed to 78%, Shanghai premium at 20%. Lease rates at 39%. This isn't a conspiracy theory, this is accounting. And the accounting says the silver market is operating with a margin of safety that is razor thin and getting thinner by the day. March has just begun. I'll be tracking the daily delivery reports throughout the month. Every contract issued, every ounce delivered, every vault movement, I'll document it here on this channel. If you want to follow this story as it unfolds in real time, subscribe and turn on notifications. Check out my full analysis of the CME trading halt, the JP Morgan SLV mechanism, and the complete silver story from $28 to $94. All documented on this channel. This is Money and Empires. The vault is 86% drained. March just started, and the data doesn't lie.